Hello, welcome back, everybody. This is the ProVisor Silicon Valley M&A Affinity Group meeting. I'm Roger Royce, a partner with Haynes Boone in downtown Palo Alto, doing emerging growth and venture capital. And we have a featured speaker this night. It is Lu Zhang, the founder and managing partner of Fusion Fund. So she's a local VC here in Fusion Fund. And she's also been a serial entrepreneur, a Stanford Engineering alum. She has a strong technical background, and she invests in technologies primarily, it sounds like. For example, companies that do AI in healthcare, enterprise AI networks, edge computing, data privacy, and they support early stage entrepreneurs, primarily, I think, in healthcare, but I think it's broader than that, as we'll find out. And she has investments in over 80 companies across the US and Canada, and has generated substantial exits over the years. And that's what we're probably going to talk most about. So welcome. Thank you for being here, Lu. And let's just jump right into it here. So the big question on everybody's mind, we all know what 2023 was like, at least for venture capital. It was not a great year. And 2024, from where I sit, seems to have been up a little bit. And I don't know if that's just my imagination or if it's true at all. But why don't you tell me, what does 2024 look like?
Yeah, so I think it depends on how you really define is good or bad for the industry. First, for VC, actually 2023 is terrific in terms of early stage venture because of opportunity of the technology trend and also the quality of the founder and integration of the new technology, especially pushed and powered by AI for digital transformation, was an amazing opportunity in 2023. So as an early stage investor, not only us, but other VC were able to invest in very high quality deal with relatively lower price. But on the other side, if you talk about the funding market, the total money raised for venture, not only just the early stage venture, and also the liquidity situation, definitely there's lots of challenge for overall the market. And we always say that it's a polarized our binary situation right now for founder, like top founder got oversubscribed round, the rest of founder had a hard time to raise money. Similar situation for VC. Actually, it's even harsher for a VC to raise capital in 23 and also potentially in 24 because of lack of liquidity. And we didn't have too many of the IPO exit. We have more active merger acquisition, but it's still ongoing. So it's actually causing challenge for lots of the fund manager. So that's kind of the ironic situation that the best time to deploy capital is always the time hardest to raise money, which also means if you have capital to deploy and also be able to really take opportunity to, buy low, it's essentially all about buy low, sell high for any type of investment. That might be a terrific investment period if you look back 3 or 5 years later. So 2024, I think one potential projection people are talking about is open up of the liquidity market, IPO opportunity, merger acquisition. I do feel very positive about situation. The Fed finally announced a couple of days ago we're cutting the rate, and also it's continue cutting by 2026 will be total 40% gone. And meanwhile, the cost of the capital will be cheaper, the risk appetite will be higher. So I think there will be more capital coming back to venture capital industry. And meanwhile, in terms of the merger acquisition, from what I heard, I work closely with several major PE firms, including like Francisco Partners and several others. They told us there's more and more strategic buyer on the market. Buyer from the PE side is really strictly follow the multiple of the revenue, and also trying to see that whether it makes sense. But for strategic buyer, they're more flexible and also open to give higher price. We have a couple company getting merger acquisition offer, pretty high price because the buyer is not only thinking about your revenue number and the times multiple. Buyer are strategic, like large corporate, thinking about leverage your technology with my existing distribution channel, with all my existing client customer. I could make how much actual revenue. If I could make actual $1 billion revenue right away this year, okay, makes sense for me to think about 300 to 500 million merger acquisition offer to start with. So there's some really positive signal for us to see. So that's kind of the positive projection. And we do think 24 will be a great year for venture, especially early stage venture. However, the challenge for VC is really for the grow and late stage VC who have a fund size potentially bigger than multi-billion, like 5 billion or even more. Because the situation right now is, first, the valuations still remain high in grow late stage, mainly because some of the VC have too much capital to deploy. When they throw in tons of capital to late stage company, the valuation goes up. But meanwhile, the valuation policy in the public side become more practical. People ask me, okay, in internet, we kind of giving company multiple based on the growth trajectory. But now it's really purely based on the revenue, and the public market is still hoping, I'll still prefer to see company are profitable when they're going IPO to give a positive feedback. So that's also still causing this gap of valuation between late stage VC versus the multiple and the analysts from the public side. So it's still gonna be a little bit challenging for later stage VC to really find the balance and also this potential multiple growth for them based on the price they invest in. Another thing is all about long term. We briefly talk about the trend of AI, digital transformation. First, we don't touch consumer, we don't touch crypto, etc. We only invest in company doing the B2B corporate sale type of business model, focus on enterprise industry innovation. So for this type of AI company, we found something really fascinating. You know, they could have a small team start to making a lot of revenue and being profitable. I have a couple company. I have a company making $100 million ARR with only less than 30 people. It's enterprise AI company. And we also have company we invested last year. You know, we're investing them when they're pre-revenue late last year, and now they're making close to $8 million, $10 million revenue, and with lots of cash on the bank account, and they don't really need raise money in the near term. This situation may continue to happen. It will be pretty binary that good AI company, essentially they could make revenue with a smaller team and lower cost, which also means they don't need to raise more capital in the later round. And if they don't need to raise a lot of money in the later round, it will be more challenging for larger VC to deploy the bigger check to top performing AI company. How to adjust the allocation and justify the price and also the multiple. That will be slightly a new situation for lots of VC to really consider. But yeah, as I mentioned, I still think it's a great time for early stage VC. Is a great time for technology innovation. We're seeing tons of high quality founder in early stage. Give you a quick metrics. You know, we're deploying Fund 4, which we just started in summer. Before that, we just finished deploying Fund 3. Most of the company we invest between 22 and 23. And among all this 28 company in 22 and 23, 70% of the founder background is repeating successful founder, which means they have successful exit and financial return in the past, and they decided to launch a new company in the past 2 years. You guys all know, you know, repeating founder, they have pretty high bar when they start a new company. Otherwise, why they give up such a comfortable life, lying on the beach, come back to this miserable founder life? They have to really see the opportunity big enough for them to consider. That's a strong signal. Another thing is we're seeing also more than 80% of a company we invest in the past couple of years, especially 2 years, have more than 20x revenue growth in the past 1 year. That's also a strong signal, you know. Valuation increase sometimes could be an illusion, but if you're in a hyper growth of the revenue, that means the industry and your customer are really adopting the new technology solution pretty fast, and also budget are increasing. So that's all the positive signal make us super exciting right now.
Okay, well, there's a lot to unpack there. You said a lot. I guess let me start the last point. That really strikes me. That's a pretty high bar. Repeat founders and 20x, you know, revenue growth. That's a pretty high. What is that? An annual recurring revenue growth. Is that what it takes to get venture money these days? Do you have to have really powerful metrics, or is it a little easier or a little harder than that? Other than your fund, I guess.
You're right. I think now venture also looking for a company be able to provide very strong metrics. It's really polarized situation that the top company get oversubscribed round. Most of founders still have harder time to raise money, because also the bar to running a successful AI powered company is also it's higher. For example, we talk about all this fancy AI solution. But in reality, when you're building a vertical AI to serve industry, serving financial industry, logistics, insurance, healthcare sector, you start to realize, okay, yes, model matters. You need to have a really good performing AI model. But on top of that, how to optimize the model to specific focus on certain vertical matters more. Because when you're using ChatGPT, we're pretty tolerant when the ChatGPT give us a stupid answer. Sometime here or there, you could just laugh about it and reply saying that that's wrong. But when you're building practical commercial vertical AI solution for industry, you have to be professional, has to be consistent, and also has to be super accurate. In order to achieve that result, you have to optimize your vertical model with industry data. So the quality of the data matters more than the quantity of the data. And who has the data? Is the industry, large corporate have the data. Then come back to what I mentioned about repeating founder. Imagine, for example, for you, two founder came to you saying that I need to access to your internal data to build an application for you for training, to train my model. One is a repeating successful founder who had track record, who had a reputation, and also another is a super smart kid from Stanford. You may like this smart kid from Stanford so much to invest them as an investor, but I think most likely you will share your data only with the repeating founder. So as a result, the repeating founder have much better channel to access to high quality data, which eventually give them a competitive edge to fine tune their model much more efficient and also lower cost. Another thing is all this B2B business model, essentially the AI solution could make money are the one doing corporate sales. And knowing how to do corporate sales, be able to really provide solution. First, they design your solution, understand the requirement of the customer. For example, we have company doing the vertical AI serving the financial institution. For financial institution, the number one thing is not better, faster. It's secure. Nobody wants to take the compliance risk and losing their job by using AI. So number one, security, and then cheaper, and then better, faster, which is the reverse order of Silicon Valley typically talk about AI need to be better, faster, cheaper, right? So that's number one thing. Second thing is just simply knowing how to engage the key decision maker from the large corporate to push for the corporate sales. AI is a relative new thing, but AI for certain industry also require both knowledge of AI, knowledge of the industry, do the allocation to the client, push for the sale. That's also eventually become another reason why repeating founder is doing a much better job, be able to secure revenue. Eventually from VC side, even for us, we don't really have a preference, has to be repeating founder or first-time founder. We like all type of founder as long as they're good. But how to really tell which founder is good is based on, do you have access to data? Make sure you have a lower cost and also higher accuracy to train your model. And also, do you have a strong metrics to show our corporate sale result? So that's kind of the analysis process from the VC perspective.
The other thing you said is kind of interesting. You referenced the Fed rate cut, and you said you thought it would make it a little easier for VC funds to raise capital because I guess they don't have to compete against the high interest rate environment that investors are getting. Do you think this is going to have an impact on exits? Because you also said there's more strategic buyers. Is this going to impact the strategic buyers and their ability to do acquisitions?
I think so. Essentially, it's really related to the cost of capital and also appetite of swallow risk, right? But on the other side, I think more importantly is all the strategic just having lots of question from the board, talk about how we build up our data strategy, how we benefiting from this AI trend, also potentially, tell the story of AI, push up our price. And also, essentially, another thing is it is a digital transformation tool. It's a productivity tool. If you use it wisely, you'll be able to potentially improve your internal margin, everything. And essentially, it's also a competition between different companies. I always talk about it's never about AI replace human. It's about doctor utilize AI replace doctor who didn't. Company who utilize AI may potentially surpass the performance of a competitor who didn't. Even just a traditional insurance brokerage company, they utilize AI will enable each insurance broker will handle more, corporate client versus the one who didn't. So essentially, that's the push for the large corporate to be more active on the merger acquisition. They could try to build themselves internally, But the thing is, how much does it cost and how long does it take? They're not a traditional tech company, and they could not attract the best AI talent to really fine-tune the model and knowing how to build it. Not to mention the challenge of large corporate doing innovation, historically based on the culture and also incentive. And that's the reason we're seeing more and more active buyers market, like more and more active buyers in the market, providing different type of exit channel for startup. Yeah, at least from our side, we're talking to our portfolio are getting merge acquisition offer from all different type of company.
Really? And what's interesting is you said several times now the data, especially if it's clean data, is really important. And it sounds, what I think I heard you say is that the AI component can be bolted onto the data, but the data is it makes a company really valuable. Is that true? And is it more true now? And is it becoming more true as we go forward?
I think so. I think so. It's more true now, even for startup and also for lots of the companies start to realize the value of the essential everything is go back to fundamental the quality of the data. Yes, we have different model evolving now. OpenAI O1 really showing the next generation of AI could do reasoning, could solve Olympic gold medal level mathematic problem, but just a bit practical, how many of the real application use case we have in the industry and real life require AI to solve a Olympic medal, mathematic problem, right? So another thing is think about when we're using AI to handle different tasks. As a human, we do two type of tasks or even any industry. One type is repeating data analysis, data summary, repeating work. It is important, but also it's kind of a wasting time and also a little bit annoying. Another type is, for example, more high intelligent engagement summary, like we're talking today, right? You guys are discussion, I share, and we digest information and also do our own summary analysis. Yes, you can use AI to do it, but I'm not sure how much satisfaction you're gonna have from the AI result because everyone have their own preference. It's all about personalization. It's not necessarily about whether AI is smarter or you are smarter. So for that type of solution, we're actually very picky. So I'm not sure like whether AI is there yet. It may eventually get there, but the cost of using that type of AI is also extremely expensive. So potentially we'll feel like probably it's better I do it myself or having analysts to handle it. So fundamentally, if you talk about a model, there's more advanced model, but now we also have access to lots of, I would say, open source model, free version. You could, no matter Llama 3 or other small model available on the market, you could directly copy paste, start to fine tune that model, make it vertical specialized for your application. But for the second step, as I mentioned, fine tuning it, make a vertical model, then come back to who have a better quality of data. Once you have the data, you could train it very cheap, very fast, and get it done. We recently also look at a company will potentially invest really good. What they're doing is using AI to do data curation. We all know Scale AI is doing data labeling, which is very simple. You label the data, make it easier for training, but still you have tons of data out there. We want to also be efficient. Out of, for example, all this a billion token, a billion data, which 20 million or even 2 million is the core data really matters for this fine-tuning and optimization of the model. That's called data curation. So instead of throwing the whole a billion data into the training model, which gonna consume lots of energy and GPU, that's contribute to the cost of AI, you could just curate the data to this core 2 million token data. Only uses 2 million token data to fine-tune the model. So cost is cheaper and also result is better. So that's also another trend of handling a data using AI, but still further validate why the quality of data really matters.
Gotcha. Okay, well, that gets me through my first question of the 10 that I wrote down. So let's kind of get into something else, maybe some more industry verticals that I know you're very invested in. And one, of course, is precision medical and digital health. And you'd already alluded a little bit to the use of AI in these verticals. But so tell me, what do you see for AI in the medical field? Is it Is it getting there? Is there great promise? Is there investment opportunity? Is there consolidation? Are we seeing the big exits? What can you tell us about that vertical?
Yeah, so as you know, I was a healthcare entrepreneur, so I have lots of passion for healthcare innovation, and I've been promoting and investing AI in healthcare since 2016, 2017. We published the report and talk about it in JP Morgan Healthcare Conference. We've been really want to call for talents and capital to really look at AI in healthcare, because not only AI could enable healthcare innovation, AI also need healthcare industry to showcase the capability, because go back to what we discussed just a few minutes ago, that the quality of data really matters, and which industry has a huge amount of high quality data? Healthcare. Also diverse application use cases, healthcare. So for our focus on the innovation and investment, two different direction. One is a clinical level application using AI powered digital diagnostic, digital therapeutics, digital biology. All this AI powered digital solution be able to really help us achieve the ultimate goal of the healthcare clinical application is personalization. Digital diagnostic, digital therapeutics for cancer, heart disease, especially mental disease. We're seeing this aging population across the world, and the progression of the dementia, other mental disease is not necessarily one solution for all, right? Has to highly personalized, but how to track it, all the data to do a more accurate early diagnostic, and also be able to contribute to a personalized treatment plan. We need to use AI. So that's one direction we've been investing, having lots of great momentum right now. And on one side, it's really the technology innovation. Another thing is lots of the buyer from the traditional pharma healthcare industry are looking at the digital clinic solution to integrate with their existing roadmap of the service of the technology they're providing, because again, innovation AI still need data to really make it happen. But meanwhile, there are also lots of standalone companies are doing extremely well. We have a couple company using this approach since 2015, 2016, focus on, for example, AI-powered bioinformatic platform with microfluidic technology for cancer diagnostic. You could detect cancer as early as when it just occurred with a small single cell, and also be able to have the recovery treatment plan very easy and also low damaging to the body, and make it possible. So that's one direction. And also even for, by the way, another thing, even for some digital therapeutic solution, not only technology is ready, good news is insurance companies doing reimbursement since early this year. Finally, we got them covered this solution. Then patients are more willing to use it, and also more data collecting. So that's one area. Oh, by the way, you also mentioned about the precision medicine. So basically AI for drug discovery. So for AI for drug discovery, people have a wrong perception that using AI, we're gonna make drug much faster. That's not the case. The reality is no matter how many target you select from using AI as a productivity tool, you still need to go through 7-10 years clinical trial period. That part is still long. So it's gonna still take us the whole process of making a new drug available on the market. But the benefit of using AI is it used to only have 10 target. Now you could quickly have 100 target with lower cost. You used to have 10 target goes to clinical trial, potentially have 2 work. Now you probably have 10 goes to clinical trial, and also have 5 or even 7 works. The increase of success rate. So still we need to wait for 7-10 years for a new drug to be available on the market, but you probably have more. That's how the math work and productivity improvement. But in terms of the merger acquisition exit opportunity for the AI powered drug discovery platform, is still, to be honest, a little bit challenging. We didn't see many of the large merger acquisition happening yet, and company one has to also able to build up the manufacturing production line of drug manufacturing, not only just discovery, to become a standalone IPO ready company. So we didn't invest any company doing drug discovery per se in the past couple of years. We're still monitoring the sector, but lots of good technology momentum. And the other direction I mentioned is really just using AI to handle the healthcare data. We have company doing AI to do medical image enhancement, AI pathology, doing medical coding as simple as it, or even use federal learning to help hospital data hospital to monetize data. That's another field of using AI. So you can see I didn't mention too much about hospital IT because that's a very fragmented market. It's very hard to justify a bigger access deal. But for other area, the two direction I mentioned, lots of activity of innovation, lots of potential merger acquisition.
Okay, we got a question in the chat here.
Yeah.
It says, I attended an early stage VC conference last week. It appears VCs are interested in true AI startups in different verticals, and that is about it. A comment on that?
Yeah. I assuming you mentioned true AI application is AI application making money and solve the real industry problem, which I totally agree. Because as I mentioned, never touch consumer AI. I feel lucky never touch consumer AI. I still think first, maybe I'm not the right user. I just don't understand why we need to create a funny photo, funny video every single day using AI. That's not a must to have for me. And I don't know whether it's a sustainable business model for lots of companies using AI just to create a funny photo, funny video, including even for influencer. And I do know company like TikTok, YouTube, they're training their own model. Even Netflix and also Disney, they're training their own model because they have access to tons of high quality consumer data. It's very easy for them to train a model. The model may not be as easy to use as high quality as whatever available on like a Sora, Runway, Midjourney, but they're on the platform already. They might be free. So I was telling with my team saying that yes, maybe there's opportunity with consumer AI, and the 90% of this will be dominated by the large tech company existing platform, including think about for individual user all of us, where do you have your highest quality of the data? Your consumer data is actually on your iPhone. It's within your Facebook account, your Google email. So all this tech company is very easy to build up AI feature on top of what they have already and make money elsewhere in order to justify the business model. So that's the reason we don't touch consumer AI. We don't really think lots of the business model there are really sustainable. Versus, give you an example, similar technology, use AI to generating funny photo. That's kind of a computer vision technology, right? Plus generative AI. We also use computer vision plus generative AI in healthcare. We have this company called Stanford Medical. What it does is using AI to upgrade low quality, low resolution medical image scan. For example, you go to hospital, you have two options: 5 minutes low resolution CT scan, 2-hour long high resolution MRI CT scan. We all know high resolution is better, but nobody wants to stay in the machine for 1 hour or higher or longer time. So what they do is patient just take a 5 minutes low resolution scan, AI upgraded to high resolution right away. For FDA approval, 2 CE mark purely software, they've been in the market since 2019, over $20 million ARR. I see that as a must to have. And I see that, it's really better, faster, cheaper for all the patient, also lower radiation scan, which is really benefit for everyone. Also think about for hospital and also physician. Physician loves it. They don't need to wait there for 1 hour, make sure there's no liability watching the patient. And also hospital could handle more patient per day, productivity improvement, capacity improvement. That's how we see the sustainable business model.
Gotcha. Okay, and any other question? I want to open this up for additional questions from our group here. So it's not just all me. Any other questions? While we're waiting, we chatted a little bit earlier about my favorite industry, agriculture, and you have made some investments in ag tech. Can you talk a little bit about where you think that's going?
Yeah, we made some investment in AI in agriculture back in 2017. But at the time, the tech was interesting, was very useful, but the margin of this industry in general is really low. For example, they try to sell to the farm owner, but they like the solution, they're not willing to pay because the margin is low and the cost of technology is really high. But right now, we think there's a new opportunity open up because of access to space data. Many people watched the successful launch of Starship a couple months ago, but more importantly is the cost of the launch is really low compared with the traditional approach. Like the current cost of the launching of Starship is $100 million, already 20x cheaper than the one that Boeing In the next 3 to 5 years, the launching cost could be as low as 10 million per launch. What does it mean? Every single Starship, as the largest rocket in the world, they could carry at least 100 people per launch, 650 satellite per launch. So is that magnitude increase of existing number we have? If you do quick math, 10 million for 100 people per person is 100K. Then let me ask you, if said there's a possibility you could go to moon for space travel for 100K, are you going? The recent launch that billionaire spent 100 million to make the trip and potentially only 100K per person. And for satellite, 650 satellite per launch for only 10 million per satellite is only 20K to launch a satellite, which means the satellite data gonna be extremely low cost because the satellite launching is so cheap in the future. Now it's $1 million minimum per launch. In the future will be 20K per launch. I want to have my own satellite in the future, if it's only 20K, probably same for you guys. So why it relate to the farm tech? Because lots of the application open up by accessing to satellite data related to agriculture, agri-tech. Give you an example. We talk about, for example, carbon emission, right? We want to track the carbon emission of livestock because it's the biggest contributor to this carbon emission situation now, cars. There's an existing technology using sensing data of the satellite and the image to accurate tracking the carbon emission for every single cow in the farm. Why we're now using it, why we're now hearing people talk about application using that data, because it's so expensive. But in the future, since the satellite data will be very cheap, you could use that data to just tracking the carbon emission on every single cow and make it available. Another application use case, just as simple as I want to buy a farm, as I mentioned to you, in New Zealand. I don't need to fly 17 hours from United States over. I could use satellite data to do analysis. How's the situation? How's the number of the cows jumping around? How's the landscape look like? All possible available, and down to very specific application, tracking the how's everything going on with this automation farm and when to pick up this apple and cherries, etc., related to some low cost robotics, soft robots related in connecting with AI data. Yeah, that might be possible in the near future for us to revisit agriculture tech because of access to data will be cheaper, and also cost of technology will be cheaper for this industry. But fundamentally, it's still this is a low margin industry, so you eventually has to really justify the margin and also productivity requirement for this industry to apply technology. Yeah, I saw we have more questions coming up.
Yeah, so Gunther asks, I'd be interested in Lou's thoughts on non-Silicon Valley venture capital, startup development, as well as international markets. I think you're asking about alternatives, like sources of capital, perhaps, and non-local markets. What do you think?
Yeah, two questions. Basically, first is really the non-capital. So there are lots of venture capital outside Silicon Valley as well. They're pretty active, but still, the center of the innovation still happening in Silicon Valley. Even for us, 60% of company based in Silicon Valley. Also, majority of the more than 50% of VC capital of the United States still in the Silicon Valley, and lots of VC relocate to Austin or Dallas during the COVID for better tax benefit, and now they're moving back. It's just access to the talent and data really matters. Besides the VC capital, there are more and more active venture debt provider on the market. We all know what happened with Silicon Valley Bank last year, which is a really sad story because that's a really nice bank and an important supporter to founder providing venture debt. But the good thing is now many banks came up saying that we want to become a next generation Silicon Valley bank. We want to provide venture debt. Another good thing is when I initially mentioned, a good AI company right now, they're making revenue much faster. When they have revenue early on, they could consider venture capital diluted funding versus venture debt, non-diluted funding, and also other source of non-diluted funding, because U.S. government has been very generous in the past couple of years. So that become more dynamic sourcing, the kind of capital source for startup companies. Funny enough, now because of the geopolitical issue that everything related to AI become a national security matter. So US government, DARPA funding, NIH, NSF, even lots of military-related institute are giving lots of non-diluted capital contract to the early-stage startup. And for international market, so the reason I'm actually sorry, I'm very excited about the meeting today. You see me sounds sleepy, like it's because it's like 5 a.m. my time. I'm actually in Korea right now. I had a quick trip in Singapore past week, attending the Mucon conference. It's similar to Davos, and also stop by in Korea before my my flight back to California later today. So I also try to learn what is going on the international market. I think one good news for US is all the capital are thinking about how to come to US market to invest. So we're having all the international capital coming to US and only US. Used to be US or China, US or Hong Kong. Now it's only US for both public and private. Another news is all the top talent are thinking about how to start up in United States. So we are seeing increasing number for European founder in the past 2 years, relocate from Europe to United States to start a new venture, and also similar things are happening within Asian founder as well. People talk about Southeast Asian market, Indian market, a lot in the past couple of years, but they found for this trend of AI, the true AI vertical application making money on the B2B side, US have the best corporate style B2B market in the whole world, not one of the best. That's the benefit of tracking innovation come over.
Okay. One more question. Do you see a bubble in AI valuations that will require a correction?
Yes, yeah.
Well,
Just yeah. So the thing is, yes, there's a bubble on the AI valuation. When people ask me whether there's a bubble, I'm like, there's no bubble about the technology trend because it's happening, but there's a bubble in valuation for sure. It's getting too expensive right now, partially because we still have too much capital. So the valuation got boosted up. Another thing is really just a fearful missing out. People are still using the mindset of internet trying to give valuation to AI. My take is, yes, AI is a very fancy idea, but fundamentally it's an enable technology. AI for insurance, AI for healthcare, AI for logistics, sounds like AI for something, but fundamentally this AI in healthcare company is still a healthcare company. Eventually, when you value this company, when you're giving a valuation multiple on the public side, it's still most of the valuation policy will come from the healthcare multiple and the healthcare EBITDA instead of just a purely AI tech company. So that's the part I feel, we have to be very practical on the valuation. Consumer AI, again, same thing. You probably see all this crazy news, mainly from consumer AI company getting crazy high valuation while they're losing money, and also foundation model company like OpenAI, XAI, while they're losing money, but they're having really high valuation. Both two companies, the reason valuation is high is also from the reality that they need to burn lots of cash in order to push their technology and also growth. So in order to justify the dilution, they're asking for very high valuation. I really don't see that will eventually go anywhere. When people ask me, oh, should we invest in OpenAI or other foundation model company? I'm like, I don't know how much multiple you're looking for that type of investment because the valuation is too much. Consider how long does it take for them to really become profitable. So I think the correction may happen sooner than our expectation. I think may happen even in the next 1 year or two, which, to be honest, for some consumer AI company already happened this year. For example, Character AI, it was supposed to be one of the hotter consumer AI company, right? But eventually the exit is essentially bad for investor because it's at most 1x, 1.5x for latest investor. And they're also the margin and also the growth is decreasing. So essentially it's a expensive acqui-hire from the strategic buyer. So I think the correction is already happening for consumer AI company. And for some new model company are building right now, start with $1 billion mark. Yeah, we'll see. We'll have some of the companies survive and become the winner, be able to do IPO. But just let me ask you, 5 years from now, if all this foundation model company gonna go IPO, because their valuations are already at least over $50 billion, could public company take more than 3 or 5 IPO in the same category, doing the same foundation model with valuation higher than $50 billion? I don't think so. So maybe only one will be able to IPO, be able to justify their valuation, get a nice exit. Others need to think about merger acquisition. But how many companies in this whole world can buy a company for more than now $50 billion, $20 billion company? Very few, right?
Right.
So just do the quick math. It doesn't necessarily give you the exit multiple you want.
Yep, I get it. Okay, well, you've been very generous with your time. We're at the top of the hour. And I know you got to go catch a plane back to San Francisco. So thanks for joining us in basically the middle of the night where you are to talk with us. It sounds like you're very excited about AI in data and all of the various verticals, and you're especially very bullish on Silicon Valley itself and inbound investment. So thanks. This is Roger Royce. We've been talking with Lu Zhang. I'm going to go ahead and conclude the discussion.